Amazon stock price has been decreasing over the last year, hitting a high of $188 a share. It currently sits at $113. Now, what we're going to do in this video, folks, is run the numbers on Amazon to find the intrinsic value of this company and what price you should be buying it at and whether it's a good investment or not. Now, here's the thing, folks. There's three key and core reasons why this price has been decreasing. So if we just drop into this stock research app here, we can see that this price has been decreasing over the last little while as we zoom in. But those three key reasons are simply this. It has missed, in the last 2 quarters, it has missed earnings. We'll see what happens on October 26th once they report earnings again. So investors have been a little bit shaken up by that. It's usually when a company misses their earnings, the stock price falls down a bit, as well as the 1-2 punch combo being for the second reason. Interest rates have been going higher, thus creating a higher cost of borrowing. And number 3 being inflation has also been on the rise. So that 1-2 punch combo with inflation going higher and interest rates going higher, people's buying power has been going down less. So they are not having as much disposable income to go shopping on a site such as Amazon to buy, let's say, frivolous things. Now, does that mean that it affects the stock price directly? Not necessarily, folks. So here's the thing. I think it's more affected by people's perception on the earnings report rather than what people are actually buying. But that will have a greater effect possibly later on in their revenue. Now, with Amazon, with my software here, we are grading this company a 5 out of 10. Now, what does the software do? It takes a look at the cash flow statements, the income statements, as well as the balance sheets to grade this company with a score. So we're scoring this a 5 out of 10. That is not too good, but we'll find out what the company is doing right and what they are doing wrong. So in the case of Amazon, they have a high ROE. They have amazing EPS growth, as we can clearly see here. 19% for ROE, which is phenomenal. We want this number over 15%, as well as EPS growth is 229% up over the last 5 years. So that is phenomenal to see. We have a high return on invested capital average, currently sitting at 10%, which is great. That means they make a phenomenal return on their money. We have high revenue growth. So our revenue growth has been going up over the last 5 years, as well as our net income has been going up over the last 5 years as well. So those are the top 5 things that this company is doing right. Now, what they are doing wrong is that they have a high PE ratio, currently sitting at 101.38 on average. So we don't want to see that. We want to see companies that have a PE ratio with a 22.5 or lower, as well as their current ratio is extremely important to me. And that is sitting at 0.95, where we want to see this number 1.5 or higher. That means they have enough assets on hand to cover their liabilities in case of an instance where they have to sell off some of those liabilities. Or so they have to sell off some of their assets to, let's say, pay for those liabilities, let's say in the case of a recession, or let's say super demanding interest rates that have been going through the roof, or whatever scenario. And our debt to equity is another scenario where we are getting hit pretty hard, folks. That is 84%. We want to see this number beneath 50%. So they're getting no points from me over here, as well as they are slightly diluting you with a share dilution of 1.20% of an increase of shares over the last 5 years. Not the worst thing, folks, but that means that you are sharing more of the pie with other investors. And look, it makes sense. People like the stock, and usually what businesses will do, if they see the stock is popular on Wall Street, they will issue out more shares, because why take on more debt when your shareholders will pay for that equity, right? So they haven't been doing it that much, but nonetheless, it is an increase, and they're getting no points over there, as well as their 5-year free cash flow has been on somewhat of a decline over the last 5 years, so not healthy to see at all. So those are the 5 things that Amazon is doing right, and contrast and compare to the things that they are doing well. It's a split down the middle. They do have a decent Altman Z-score sitting at 3.97, where we want to see this over 3, and they have that no problem, as well as our Piotrowski score is sitting at 5. We want a number between 7 and 9. 9 is the highest number we can possibly achieve, and 5 is pretty mediocre. That means over the last year, they've only hit 5 of the 9 categories Now, the one thing that you're probably wondering is, what is this company actually worth? Well, my software does just that. And what we'll do, folks, we'll do a 10-year analysis on Amazon to find out what we should be paying for the company today using the historic averages. We'll input 3 different assumptions and we'll see what this company should be priced at today. Let me just fill out these boxes and we'll touch base in just a quick second. If you're enjoying the video so far, before we jump into this last section, hit that like button, hit that subscribe button. This software here will be available to you, my viewers and subscribers, sooner than you think. So jumping in, I'm going to hit the calculate button and we're going to find out what we should be paying for this company today. Now, if you're new to the channel, I like to try to stay as conservative as possible. So I'll tell you what I just did. So with Amazon, I assumed a 10% revenue growth on the conservative side, 14 on the high side, as well as I kept my profit margin and free cash flow margin similar to what we've done over the last 5 and 10 years, as well as our price to free cash flow. I put it in some realistic numbers beneath that 20 range. So I am speculating a little bit, but I have to assume they're able to get to those numbers to try to make a very fair evaluation, as well as our PE ratio beneath that 22.5 mark. Now, if we just scroll down here, you will see that we're not hitting our conservative estimates, but currently average calculation comes out to be $176.33 based off of what our metrics are over here. So here's the only thing, folks. Here's the only thing where there is a little bit of a discretion, is that our price to free cash flow evaluations have to be taken lightly. And I can't say for a $1.2 trillion company, maybe these revenue growth numbers are somewhat linear. And I did a 10-year now. I did a 20-year analysis, guys. Oh, I'm so stupid. Let me do 10 years. This is what I usually like to do. Let's do 10 years. Sorry to give your hopes up. To over 20 years, it's showing that it's undervalued by pretty much. Okay, that makes a lot more sense. So in a 10-year outlook, unfortunately, the price gets cut in half. So if you're about to jump on board and say, oh my God, Amazon's an undervalued company, I apologize. But in a 10-year outlook, our current calculation comes out to be $64. Now, as I was saying, with the price of free cash flow currently sitting in the negatives, so these are speculative numbers assuming they were in this range. So on average, we should be paying around $64, pretty much almost half of what this company has been currently priced at based off the numerics that have been shown. Now, do I think this 10, 12, and 14% revenue growth numbers are a little bit excessive? For a $1.2 trillion company, this might be somewhat of a reach. I can't expect this company to continue to grow at that amount over the next little while, because as the company gets larger, it is harder to grow. So what do I think? I think at most, it'll be in this conservative range, being the highest that it could possibly grow. I think it could potentially be, it might start at 14 and then just eventually start tapering off and going lower and lower, or rather just starting at 10. I got to give myself more of a margin of safety, so I might even just drop this down to 7. Now, it doesn't help my case by a crazy amount. It's just going to drop this price lower to the $30 range, and you might think that's a little bit ludicrous, but you have to anticipate over the next 10 years how much revenue can this company possibly bring in, and how fast can this company grow. Now, they very well might just crush my numbers completely, but I need to make sure I put myself in a predicament in case I'm wrong. In case I'm wrong, I'm not wrong so much. And if I'm wrong in the sense where they do beat my numbers, then that works out better for me in the long run. So on average, $60 a share for this business, currently sitting at $113. So if the interest rates keep rising, as well as inflation keeps going higher, it's going to cause people to not spend as much money on Amazon and using that site. So what that means is that revenues will probably decrease even more, and they'll probably miss earnings as well in the next earnings calendar date. So we could probably see this rinse and repeat cycle where as we enter into a recession, we might see the stock price drop lower and lower due to the fact that, well, people are just simply not buying as much stuff. They don't have as much disposable income. Now, does that mean that, oh God, we're in a terrible spot for Amazon? No, because listen, the economy and the stock market comes in waves. So when this recession eventually hits and we see people not buying as much, there will be better times ahead. And at some point, this stock price will be at an undervalued state. And I don't think Amazon's going away for the time being. So until that time comes, I am staying away from this stock until it's in the undervalued territory. And for me, that's below the $60 mark. I would say probably closer to $40. So it's got to drop in half at least. That's from my perspective. Now, you may disagree with me. Write down your thoughts in the comment section down below. And if you want to see a company evaluated, write it down there as well. Thank you so much for watching, and I will see you in the next video.